What's up, guys? Welcome to Hodlers and Traders Hub, the home of simplified cryptocurrency education and content. So basically today we're just going to be continuing with our series on beginner friendly crypto trading and beginner friendly crypto education. So basically today we're going to be touching on practical ways in which you can become a trader, the very beginner session. So if you're new here, this is a session that you might want to sit back, relax, and then check out. If you're old here too, you can learn one or two things from this session. So this is a practical session for absolute beginners who are just getting started into cryptocurrency. So without much ado, let me just get into the video. So our very first model we're going to be touching on, we'll be talking about trading tools. So here we are going to be looking at our cryptocurrency exchange, the exchange in which we're going to be doing our very trades on. So we're going to also be looking at the charting tool. This is the place where we're going to be doing our technical analysis. We are also going to be talking about some types of trades and going into subtypes of trades, so spot trading and then futures trading. So if you have been following our video, our session for the past week, we listed various types of trades. I think that was last week. The video should be linked anywhere in the description, so you can go and check it out, the various types of trades that we have. So today we're going to be delving deep into spots and then futures trading. Our next model we're going to be talking about will be touching on the technical analysis or the technical aspect when it comes to cryptocurrency trading. So that involves us talking about the various types of charts. We talk about price action and then price trends. We're going to be talking about support and resistance, touching on supply and demand levels. We're also going to be talking about candlestick patterns, and then we're going to be touching about trend lines, and then chart patterns are also going to be part of our technical aspects when it comes to cryptocurrency trading. Our model 3 would be talking about technical indicator. So we're going to be touching on some very popular indicators, which is like the RSI, the stochastics, the moving averages, some divergence tools, and then the volume profile when it comes to cryptocurrency trading. And then our model 4 is going to be talking about our trading strategy. So this would evolve around the kind of traders that we are, the various time frames that we use to trade, and then we're going to be touching on risk management and portfolio management. We're also going to be backtesting and involving some of our trades, and at the end of this session we should be able to take our very first trade. So this is the session for today. I hope you guys will learn one or two things. So sit back, relax, and let's get into it. So as part of our very first model, we're going to be talking about the exchange we are going to be using for cryptocurrency trading. So the exchange of choice where we typically trade on, or I typically trade on, is Binance. So there are various types of exchanges when it comes to cryptocurrency trading. Each one has their advantages and disadvantages and their flaws and their merits and all of that, but my preferred default is Binance because it's the largest exchange when it comes to trading volume. It's also been an OG in the game, so it's a place where if you followed our previous video, we talked about crypto exchanges and crypto wallets. So you want to put your money, or you want to trade at a place where you can feel a little bit more secure. You put your money in there, you're sure you're going to be withdrawing your money, you're not going to be the exchange is not going to be collapsing tomorrow and stuff like that. So I kind of like Binance and I like their business model. So all you have to do is go on binance.com, and then you should be able to sign up. If you're finding it difficult to sign up, we have an article on our website hodlerstraders.com, where we talked about how to register on Binance and complete your account verification, a step-by-step process. So we talked about the KYC and all the steps you need to go through to verify your account with Binance. So this is a very simple tutorial. It's a very step-by-step straightforward tutorial. You can come on our website once again and just look for verification on Binance, and this article should pop up and you can take a look at it. So this is a very simple way to sign up onto Binance. So these are exchange too. So these are exchange for trading, sorry. So basically our next session we're going to be looking at will be our charting tool. The charting tool is where we're going to be doing our technical analysis. We're going to be looking at the charts. We're going to be looking at the charts using our charting tool, and we're going to be doing various analysis on the charts based on price action, based on candlesticks, based on trends, based on analysis, based on volume, a lot of technical indicators on the charting tool, and we're going to be using that to do our analysis. So charting tool I recommend will be tradingview.com. So tradingview.com, that is a charting tool I would recommend you download or you get. It's an app, it's on your phone, you can get it on your tablet, you can get it on the web. So this is the web version, which is tradingview.com, and this is the tool that we're going to be using to do our technical analysis. It comprises like it's a whole comprehensive tool when it comes to trading. It's a trader's Swiss knife. Like, it's a very, very sharp tool that every trader or potential trader that is looking to get into cryptocurrency trading should get. But if you do not have TradingView, you can also use Binance's default charting tool. So you have to go on trade, and then you go on spot. So go on spot. Remember, we're going to be talking about two types of trades, which is the spot trade and then the futures trade. So basically, you go on spot, and then it should present you with the charts. You have this overview of so this is by default Bitcoin, the price of Bitcoin right now, the orders here, everything around Bitcoin on the Binance platform. So this is the charting tool for TradingView when it comes to Binance. So you can also use this to do your analysis. Let me just zoom out. So you can use this to do your analysis. Yes, so they have time frames, they have indicators, they have trend line tools, they have analysis tools, and you can also use this to do your analysis on your chart. So you can also find this on Binance. This is the default Binance trading tool, just like TradingView. But to me, TradingView is the default, so you need to be using TradingView because it's more flexible. It has a lot more tools, and it's the standard when it comes to charting tools in the trading industry. So, but nevertheless, if you want to also use the exchange's default charting tool, you can also use. You can see there are a couple of tools here: Fibonacci, short and long, text, trend lines, and stuff like that. So you can also use this as your charting tool. So right below the charting tool, we're going to be talking about spot trading on Binance. So spot trading, this is the section where you spot trade. So spot trading is basically buying right on spot. You can also buy at the market price, you can buy at the limit price. There are various types of orders when it comes to spot trading. So this is where you would be doing your default trading by default. So here I want to say something. So if you are an absolute beginner when it comes to cryptocurrency, you should at least trade spot market for, say, at least 3 to 6 months. So this would give you a hang of how to trade the market without the necessary pressure that comes with advanced form of trading. So what we do at Hodlers, we do a lot of futures trading, and we're going to get into that. We're going to get into how to do futures trading without necessarily losing your money upfront. So, but for now, we're going to be looking at, if you are a beginner, an absolute beginner, you should actually start with spot trading. I actually personally myself, I spot traded for like 9 months. I spot traded a lot. Like I was spot trading a lot. I wanted to understand how this whole thing works, because I mean, let's face the fact, you're putting your money into the market, you're risking your money into the market. You don't just want to get into something you do not understand. So if you're a beginner, I would encourage you to spot trade for at least 3 to 6 months to understand it. The goal is for you to understand the concept of trading when it comes to sports. But we'll get into more advanced form where you don't have to, you can actually do advanced form of trading without actually losing your money. So when it comes to spot trading, this is where you take your orders. This is where you place your orders. So we have different types of orders. We have limit orders. Limit orders means that you can actually choose the price at which you want to buy, for example, Bitcoin. So at this price, Bitcoin is at 50,700 and something, 50,500 and 30,565. Why do I keep saying 50,000? 30,500. So you can actually choose to say, okay, I am buying Bitcoin when it goes to, say, 24,000. Let me just transfer some funds into this spot trading account, and then let's just. Okay, so in the in my spot trade, If you also want to learn how to buy and sell cryptocurrency and send the funds into, we have an article on the website where we talked about how to buy cryptocurrency and how to fund your account. So it's all of there. So I just transferred $5 into my spot trading account for demo purposes. So for example, this is your spot trade tab. So the thing about spot trading is you can typically, it's not, there are so many other variations of spot trading, but typically in spot trading you can only buy to the top. So typically when people start cryptocurrency, they are looking to invest mostly. So you're buying low and you're selling high. You're buying low and you're selling high. There are various forms of spot trading. Like I mentioned, we'll be getting into that, leverage tokens and 3L tokens and 3X tokens, where you can actually short and long in the spot market. But for now, typically when you're buying when you're buying on spots, you're just buying low and you're selling high. So for now, BTC is at 30,600. You would probably, before you actually would take your trade, so you'd want to go into your charts, you do your technical analysis and say, okay, BTC is at 30,600. Okay, I believe BTC is going to go to, say for example, 40,000. So let me buy BTC at this price. And then how much BTC am I buying? So currently in the spot account I have $5. So how much BTC am I buying? So you can choose 25% of that $5. You can choose to buy half of it, which is like 2.5, or you can choose to buy all of it. So it tells you, so the more you slide, you pull your slider, it tells you the amount of Bitcoin you can actually buy, 0.06 of it. So I'm buying for $5 worth. So you should also consider there are fees that the exchanges charge when you are trading. So these would not necessarily be $5 as such, but yeah. So I'm buying BTC at this price. I'll buy it at 30,600, and then I would hold it for it to get to 40,000. That is after you've done the analysis. So we'll get into how to buy and where to buy and stuff like that. Typically you shouldn't be buying at this highs anyway, so that's because you need to do a lot of technical analysis and see the right places you need to buy. So typically at spot trades, this is what you do when you're buying at this market. So let me just execute a spot trade here. So let's say for example, I'm saying when BTC gets to 24,500, this is where I want to buy at. I want to buy all the $5 when it comes to 25, when it goes to 24,500. So I'll execute by BTC. So this is what I'll do. It said it's more than 5%, blah blah blah. Do I wish to continue? And then I would continue, and then I continue on buying. So this would set an order for me. The value should be more than 10 USD. Okay, so let me just stop up and then make it 10 USD so that I can be able to buy this BTC. Okay, so I just topped up my account and I'm back to $15. So once again, going back to the example, when Bitcoin is at 24,500, I want to buy all the $15 worth of BTC. So typically, like I mentioned, with spot trading, you are buying and you are holding typically, because there is no there's a concept called liquidation and margin calls and stuff like that. With spot trading, none of that happens. But of course, there have to be risk management. If all your money you are putting into cryptocurrency or you're putting into this trade is, if you're buying to hold for the longest term, say for example you believe that after doing your analysis, not even believe, after doing your chart analysis, which we are going to go into, you know that Bitcoin, your analysis says Bitcoin is going to 40,000, and you shouldn't obviously be putting all your $15 into the trade, because once the trade goes against you and you might choose to say, okay, stop me out at this price. Maybe for example you put all the $15 into it, you've lost all the $15. So you should typically be putting in 1 or 2% of your entire portfolio into every single trade. So we're going to talk about that when we get to risk management and stuff like that. For now, we're just executing a spot trade, and then we're buying $15 worth of Bitcoin, so it gives us 14.999 this. And then so that saying that when Bitcoin is at 24,500, buy this amount of Bitcoin in and then so there will be an order that will be placed. So we're buying Bitcoin. It says 5% away, whatever. We just continue. This should place an order for us. Okay, so our order should be executed. So this is our order here. So our order is placed, and then we are waiting. This is our limit order which has been placed here. So when Bitcoin, the price of this Bitcoin, which is 30,596 right now, when it comes down to 24,500, this order will be executed, and my $14 worth of BTC would be executed. That means I bought Bitcoin at 24,500. That is the concept of spot trading. It's very simple. So typically you buy on spot and you hold it. So with spot trading, you do not face, like I mentioned, liquidation. So it means you can hold it for years and years and years. So if you're looking to invest into cryptocurrency as a beginner, this is the place that you need to use. You need to use spot trades. So you need to come on spot and then you buy Bitcoin at a certain price and then you hold it. If you're also day trading spots, there are also ways to go about it. So you would buy here, typically you would hold it for it to get to your take profit level and then you execute. So if you want to sell it, this is a sell tab. So let's say, for example, this executed and wanted to sell at the price 40,000, would now have to enter 40,000 and then would sell everything. Maybe at that price Bitcoin did like a 2% 3% move, so that will be 2% of our $15, and that will give us a total, and then we'll come and execute our sell option here. So this is it when it comes to spot trading in cryptocurrency. So it's very simple and it's very easy for everybody to execute. So basically that is what it is when it comes to spot trading. Okay, so because we do a lot of futures trading here at hodlerslab, I would want you guys to follow up. So I'd want you guys to typically go on Google and type mock trading. So this is going to open a demo account for you. This is going to open a demo account for you, and then we're going to use it to trade futures. So this is what we're going to be doing. But remember, I mentioned futures trading is an advanced form of trading. So this demo trading is the demo account is going to help us to practice a lot when it comes to day trading, when it comes to swing trading, when it comes to our psychology. And then the difference, some of the difference between spot and futures typically is that with futures you can make money when the market is going down too. So remember I mentioned when it comes to sports, you can only make money when the market is going up. Typically there are various variations of sports trading where you can use 3Ls, 3X, leverage tokens and stuff like that. Those are like different forms of, but typically for a very beginner, when the price of the crypto is down, that's when you buy it and then you sell it at the top. That is spot trading. But with futures trading, you can actually make money in both ways. So when it's down, you buy it, you sell it at the top. When it's at the top, you buy it, you sell it at the bottom. So you buy high, you sell low, you sell high, you buy low, and each of these you make profit with it. So basically I want you guys to go on Google and type mock trading. So this is the type of demo account I want you guys to open, mock trading on Binance, mock trading. So this gives us access to do demo trades. So demo trades is what we're going to be taking on. So once you open your mock trading account, you would be asked to sign up with your Binance username that you used to sign up and all of that, and it gives you a default amount that you can put in there. Sometimes it's 3,000, other times it's 10,000, and I've seen 15,000 and stuff like that. So you have a default amount to play with. So you can see it is not a live account, so it says back to live. So this is a demo account. This is a demo account for you to play with and to understand how to do futures trading. Futures trading is an advanced form of trading. Like, it's a very advanced form of trading, and it requires a lot of techniques, and we can't go deep into that in this video. In subsequent video I will do a dedicated video about futures trading. So if you have not subscribed to the channel, please do subscribe, because I'll be posting a lot more content nowadays onto the channel. So basically this is how you would go about. There's a lot of things here, like, so there's cross margin, there is liquidation, there is advanced tools, there's take profit, there's open long, open short. Remember I said with futures trading you can go long and you can go short. It means that you can make money when the market is going up and when the market is going down. So I'll be doing a dedicated video talking about how to go long and how to open shorts, how to open longs and how to open shorts and make money whether the market is going up and down. And we're going to also be talking about leverage and position sizing. So there's a lot to be covered. I can't talk about all of that in this video because it's going to be like very comprehensive. So today is just going to be talking about the real practical aspect. So when it comes to actual trading, this is the real practical aspect. So I want you guys to open a mock trading account, because that's what we're going to be using for our futures trading here at Hodlers. So if you do not have one, or another thing you can do is to one way, but typically just start with a mock trading account. Start practicing first, understand this concept first before you put in real money. Do not put in real money if you do not understand any of these concepts that we're talking about here. Do not put in anything if you do not understand. So you need, first of all, I said, if you're absolute beginner, absolute beginner, you need to spot trade at least 3 to 6 months, and then you can then move to a little bit more advanced form, say futures trading, and then you would begin to demo trade or mock trade using some of these tools here. And before you can even begin to do your very first deposit, because before you need to, like I said, every time you take a trade or every time you go into the market, you are risking your money, so you need to understand where and how you are risking your money and stuff like that. So this is it for our very first model when it comes to futures trading practicals. So we're going to move to our next section, which talks about the charts and then price action and then stuff like that. Price action, chart, support, resistance, candlesticks, trend lines, and stuff like that. So we're going to be talking about the technical aspect of it. So we'll move straight to our charting tool. So going over our technical analysis, we'll go straight to our charting tool, which I mentioned is tradingview.com. So if you're a newbie and you're a beginner, you should be trading the king of the market, which is Bitcoin or BTC. The reason you should be trading BTC because, number one, it controls like 60% of the markets. Like, also it has a lot of Bitcoin pairings, so a lot of coins or tokens are paired to Bitcoin, so it moves 1%. The market probably, the other coins move probably like 3, 4, 5, 6%. So Bitcoin is the king of the market, followed by Ethereum, which is the queen of the market. So if you're new in the market, you should be trading those two coins. Mostly you should be trading Bitcoin. So this is the Bitcoin chart when it comes to our trading tool. So we're going to be talking about price action or price action when it comes to trading tool. So price trends. So when it comes to price trends, there are 3 types of ways in which the market goes. The market goes in 3 different types of ways. The very first way is either the market is trending upwards, either the market is trending downwards, or the market is ranging. These are the 3 types of ways in which price moves in the market. The market is either trending to the upside, the market is either trending to the downside, or the market is ranging. So what I mean by ranging, it means that the market, so for example, let's just break it down so easy. So when I say the market is ranging, let's just find a range in which the market was going up and down in the similar same fashion. So for example, look at this section. If you look at this section, price was literally going up and down, just so you can see, like, price wasn't making a confirmed move. It went up, it went down, it went up, it came down, it came up again. So this is a typical example of a trading so going over an example of an uptrend, look at this price action. So when you look at price was here at this bottom, and then it made a move to the upside, consolidated a little bit, made another move to the upside, then consolidated a little bit again, it made another move to the upside. Let me just see if I can sketch it out with this arrow. So just give me the brush tool. So price went up, it consolidated a little bit, went up, consolidated a little bit, went up, and then it started ranging. It went up, down, 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 up, down, up, down, like, and then it finally decided that, okay, I'm done with this up down movement, I want to continue with my uptrend. So, and then it just made an up move again. So you can see the price just moved to the upside again. So this is a typical example of an uptrend. So when price, you need to typically move with where the direction of price is. When price is in an uptrend, you should be going to the upside alongside price. When price is in a range, you should be going sideways. So price is going sideways, up, down, up, down, up, down, up, down. So you can just be going support, resistance, support, resistance, support, resistance, or supply, demand, like that. We're going to be speaking of support and resistance. Let me just quickly touch on that before we move on. So support and resistance is a simple concept. It's a concept where price has touched a certain point multiple times. price has touched a certain point multiple times. So for example, let's just take Bitcoin on a daily chart. Okay, so good. This is another example of a downtrend. So for example, see price, a big example of a downtrend. So let's just even take it from here. So price made a move. Give me the arrow. Where's the arrow? I need the arrow. No, I want this arrow. Give me the path. So price made a move to the downtrend. It consolidated a little bit. It made a move to the downside. It consolidated a little bit, went sideways for a little while, and then it started to trend upwards. So price went up, it came down. Price went up, it came a little bit down. Let me just undo this. So let me just find this range. Sorry guys, I'm trying to, let me just delete this. Okay, good. So it went a little bit sideways, and then it started to trend. It made another move to the downside again before it started to trend to the upside. Made a down move, made an up move, made a down trend. So every time price makes a higher high, a higher low, higher high, higher low, higher high, higher low, that means that price is in an uptrend. Every time price makes a lower high and a lower low, that means price is in an uptrend and a downtrend. So for example, look at this move here by Bitcoin. So Bitcoin made a downtrend and then it consolidated for a little while, consolidated in a ranging market for a little while, meaning that it went sideways. It wasn't showing a clear sign of an up or a downtrend. It was going to the sideways. Then it decided to break to the upside. Now when the price decided to come all the way down, it did not come all the way down to the last down. It made a higher, what we call a higher low, meaning that the uptrend still continues. Then it moved up again to the upside, and then it made another higher low before making another higher high. So this means that the uptrend is still valid and the uptrend still continues. So these are the trends in which the market moves. So the market moves is in either an uptrend, in a downtrend, or in a ranging market. So basically that is it when it comes to the trends of the market. So we're going to be talking about support and resistance next. Let me just find a good example and let's just see how it goes. So the concept of support and resistance is a very basic concept when it comes to technical analysis, and it's a very popular concept. There's also the concept of demand and supply, which means a place where price reacted. There's a slight difference between demand and supply, but today we're going to be talking about support and resistance when it comes to absolute beginner friendly trading. So support and resistance refers to a place where price has reacted a lot. So if you look at this price action, let me just draw this line. So look at this. When price came down here, it got rejected, it went to the upside, and then price came again, it got rejected, went to the upside. Price tried to break this trend line or this support line. So this is now support. Support is an area where the buyers came in a lot, like where the buyers came in and then they took the price to the upside. That is basically support, and at least it must have like 2-3 touches for that area to be super valid as an area of support. So it's support and resistance is also not a line, it can be an area. So it's not like a fixed line where price has no, it can be an area, a region, a place, an area where price would typically react. So when price came all the way down here, you can see the buyers came in here and then they bought the price back to the upside. Now price came again, it came down here, and then the buyers came again, they forced the price to the upside. But now the sellers came, they tried to push the price lower than this support area, and then the buyers came in here and then they bought the price back up once again. So any area where the buyers come in and then they support the price to the upside, that is support. Any area where the sellers come in and they support the price to the downside, that is resistance. So for example, let's just find another support here. So if we draw this line, we can see that after the buyers came in and they broke this line, they held this line a lot to this area. I'm just calling it an area, not necessarily a line. So here you can see that here this place held as resistance multiple times. So when price came here, the buyers came in here. When price came in, the buyers came in. When price came in, it tried to break, it got to the next one, they came in here. So this is an area of support. This is a strong area of support. That means that the likelihood of price getting bought back up at this level is really high. That is what it means. So it means that if you were trading Bitcoin, like for example, like I said, if you were trading Bitcoin, you need to buy on spot, you need to buy at support, and then you sell at resistance, or you buy at the area we call demand. That means that there's a lot of demand for that coin, like the buyers want to buy at that region, and then you sell at supply. So you get it. So so basically this is the concept of support and resistance. When it comes to resistance, it means that the area where the price was rejected multiple times. So look at this level. Let's just map out this level. The area was rejected, the price was rejected multiple times. So you would see that when price got here, it got rejected. When price got, let me just mark it out. When price got here, it got rejected. When price got here, it got rejected. When price got here, it got rejected. It got here, it tried to break through this resistance, but once more it got rejected again. So this is an area of support and resistance, and like we mentioned, the market is in a ranging market. You can see it's going up, down, up, down, up, down, up, down. It's not showing any clear trend yet, even though the general trend of the market is downtrend. If you follow the bigger picture and the overview of the market, when it got to this region, it started ranging. So you need to have this concept in mind: the ranging market or the trending market, and basically how to trade each of these markets. So you can see that price got rejected a lot when it got to this region. Price got here again, it got rejected. It got here again, it got rejected. Then it got here before it finally broke out. That means the sell pressure, the buy pressure here was really high. It broke, it made a huge breakout here. So a breakout is a huge area where a lot of buyers or a lot of sellers come in and they support the price with enough volume such that it invalidates that area. So typically the sellers would be here and waiting to bring the price back down again, but the buyers came in with a huge amount of volume and they pushed the price all the way back to the upside. So you need to understand these concepts of support and resistance and add it to your trading strategy, because that is where you are typically going to be buying at. So if you're buying spots, you need to be buying somewhere around here, and then you sell where there's resistance. You buy at support, you sell at resistance. You buy at support, you sell at resistance. That's typically how it goes. So even if we're looking at this price action around this region, we can tell like, okay, this came in here and then this broke this level. So you can tell like this is an area of support and resistance. So when price got here, it got rejected before it finally broke again. And now when it got here again, the buyers are trying to come in here and then buy the price back up again. So this is the concept when it comes to support and resistance. But like I mentioned, it has to be at least 2-3 touches. So this is a bigger time frame on the 4 hour. If we go on the say 1 hour, we should see at least multiple touches and rejections and candle closures below this line or this area. So you can see from here before it finally broke out, and then now it's turning it into support. And let's see if price would finally, this is the current price action of Bitcoin anyways, let's see if price would kind of break down and come here and find another level of support here, or the sellers will come in and then push the price further again to this angle. So we will see what price action does. So basically that's the concept when it comes to support and resistance. So our next topic we're going to be looking at are candlestick patterns. Like candlesticks are, you can see the chart is full of candlesticks. So even before that, let's just talk quickly about the various types of charts we have. So we have, like I mentioned, this is a candlestick chart. There are various, on TradingView there are various types of charts, and you can see them here. There's a bar chart, there's a hollow chart, there's what's the name, there is columns charts, and all of these various different types of charts when it comes to trading. And then there's a line chart. You can actually see all of this stuff. So a lot of traders use different methods when they come to their charting. So these are like various charts. These are various different candlesticks or various what's the name? I want to get the name right. Various chart types. Yes, various chart types when it comes to trading. So trading view has all of this stuff. So my three favorite ones are like the candlesticks, and then we have the line charts, and then Heikanashi is a very, I used to use that early back in the day. I used to use the Heikanashi candles. Like, they generally would form it will not. So typically, for example, look at the candlesticks. So sometimes the candlesticks can have like a lot of noise, like green, red, green, red, green, red, green, red, green, red. I remember when I began trading, like, I didn't understand this stuff and it was confusing to me. And then, like, oh, I saw the Hakanashi, I was like, oh, this is very simple. So when I switch up and then it's all green, I'm like, okay, this thing is moving. And then there's a little bit of red, I'm like, okay, now it's beginning to be like bearish or something like that. And then it became all green. So in the Heikanashi filters out the noise. Like, it's the candlestick that filters out the noise. I think it's Japanese, so it's but I have moved on from that now. I use like the typical candlestick when it comes to charting. So basically, this is it. When it comes to candlestick patterns, candlesticks are like the life of the chart. So all of these candlesticks you are seeing, all of these things you're seeing, all of these lines you're seeing, it's basically human emotions. So human emotion of greed, human emotions of fear, human emotions of everything you're seeing here, psychology, how human beings are thinking. These are all represented on the various charts that we see here. So basically, there are various types of candlesticks, and you can use them actually to predict where price is actually going to go to. So there are various types of candlesticks. There's a hammer, there's doji, there's shooting star, there's evening star, there's a whole candlestick bible. I encourage you guys to get the candlestick bible, or you can just google candlestick patterns. You would see various types of candlesticks when it comes to price action. So you can see the 3-step, you can see the evening star, you can also see so many candlestick, bearish engulfing candle, bullish engulfing candle. You do not actually, over time, you would know some of these things off the top of your head by seeing them in the price, but you do not have to like chew them. You just have to, you see them in the price, you would see them in the price action. So doji, you would see the hammerhead, you see all of this. All of these candlesticks represent the way the human beings are thinking and the emotions behind their thinking, the psychology behind their thinking. So for example, if this is a very bullish candle, it's telling me that the buyers are in the picture. You get it, the buyers are in the picture. If I see a long wick down, this is telling me no, there's a rejection, and then the sellers are in the picture. And then you can see a lot of these candlesticks. You can see a lot of morning star candles that start an uptrend. You can see a lot of evening star candles that start a downtrend. So I would encourage you guys to either go on Google and then find candlestick patterns, and then I'll be doing a lot more videos specifically on candlesticks, because we can't cover everything tonight, because we're going to be like, it's going to be a whole topic on its own. So candlesticks are like a very integral part of the chart when it comes to trading. So you can use candlesticks, you can read the candlesticks and know the possible next move of the possible next move of the price. So using the Bitcoin chart once again, we're going to be touching on trend lines. Trend lines are basically connectors. They show you how price is possibly going to react. They show you how price is possibly going to react based on price action and based on human psychology. So like I said, trend lines are like connectors. So if you can connect 2 or 3 dots together, that is pretty much a trend line. A trend line pretty much connects where price is possibly going to react. So for example, look at this trend line on the Bitcoin chart. This is the Bitcoin daily chart. So for example, when Bitcoin got here at 31,000, it got rejected. Then it got here again, trend line 29,700 about, or 28,000, it got rejected. And then it got here 28,500, it got rejected. It's expected that when price gets here again 29,500, it will get rejected. So you can see that the trend line, for the trend line to be valid, it has to connect at least three connectors, 3 dots. So you can also, for a trend line to be valid, you have to draw, you can't mix the body and the wicks. Typically I like to draw the wicks, so you can't mix the body and the wicks and say okay, that is a valid trend line and stuff like that. So this is a trend line. This is connecting 1, 2 and then 3, and then finally if you check this chart pattern well, this is called a falling channel, or a falling wedge. Typically, like, it goes up down. You remember when we mentioned trending market, and then we mention a downtrend. So price went up, it got rejected here. You can actually see the rejection candle here, and then which is like the doji, you can see it, and then it got rejected, it went up, it came down, it went up, it came down, before finally breaking through. So this concept all work together in terms of the way price reacts, the trend of price. So up down, so you can use trend lines to connect 2 or 3 points together and possibly get an area where price would possibly react. So this, again, let me just draw that trend line using this example here. So this is 1, this is 2, and then this is 3. So this is another trend line. So it's telling me that when price got, so let me just draw this one, and then it got here. When price got here, it got rejected. Price got here, it got rejected. So price rejection, like, but when it got here, they bought it back up, and price is in an uptrend. So you can tell, once again I talked about trends of the market. So an uptrend, a downtrend, or ranging market. So you can tell price was in an uptrend. It went up, it came down, it made a higher high again, it came down, it made a higher high again, it came down, it made a higher high again, it came down, before making another higher high or higher low, and then it broke this trend line. So once it breaks this trend line, you can tell, like, okay, the trend is probably about to end, and then you can obviously tell from the price action that there was a lower low. Generally, you can see from the bigger picture that the price was in a downtrend. So even though there was an uptrend in a smaller range, the whole picture says down, and then there was an uptrend a little bit, but it couldn't make a high, still at a downtrend, and then it came all the way down. So trend lines are connectors, so you should learn how to use trend lines to connect your price action and see the possible areas where price is possibly going to react next. So if you combine trend lines and you combine support and resistance, so you can tell. So for example, this is an area of resistance. So when price got here, it got rejected, so you can tell, and this trend line also rejected the price. So in the future, it means that possibly there's going to be a rejection, which happened here. You can actually tell this happened here. So this happened first here, around this area, and then it got, when price got to, it happened here, and then when price got to this area, this trend line or this resistance line also rejected it. So anything that happens in the past can possibly be a way for us to predict the future. So this trend line also got, you get it, it got rejected until finally it broke out convincingly, and now it is becoming somewhat like a support. So when it got here, the buyers that bought here, the buyers that bought the price all the way up here, they don't want the price to go below this support line again. Now this resistance has become support. Now it's holding, and then it made an uptrend to the upside. So basically, this whole concept, resistance, support, trend lines, all of the candlesticks, they all play into price action and help you to forecast where price is potentially going to go to. So for the technical indicators, we have some very popular ones that people use when they come to trading. So the relative strength index, the stochastics, the moving averages, the MACD, and all of that stuff. I'm going to be doing a dedicated video on each of these technical analytical tools and indicators, and how to use them to possibly add more confluences to your chart. You should never use a technical indicator as the holy grail that would give you the whole situation about where price is going to go to. Maybe it says something turns green, you say okay, let's buy, or something goes up, you say let's sell. No, that's not how it is. Like, you should use it as extra confluence to add to your price action after doing your analysis. So basically, I'll be doing a whole video dedicated to this. So subscribe to the channel and let's keep supporting. So last but not the least, when it comes to practical trading, is our trading time frames and our trading strategies. So basically, this talks about how we manage our trade and how we go about our trade. So speaking of time frames would typically evolve with, let me just clear all this. Time frames would evolve with the type of trader you are. So you can see from TradingView, the time frames are all here. So 1 minute, 2 minutes, 3 minutes, 5 minutes. You can, if you're using the premium version, you can add your own. So you say, for example, 30 seconds. You can add all of that. Okay, there's no seconds, so all of that stuff. So you can see all of these time frames. You can add 2 weeks. You can add 1 month. And if you start to become your favorite and to line up here. So the the time frames when it comes to trading would indicate the kind of trader that you are. So there are people who trade, for example, the monthly time frame, and I would say here that the higher the time frame, the more convincing the move, or the more solid the move. So for example, the monthly chart is stronger in terms of price action and confirmations than the weekly chart. The weekly chart is stronger than the 3-day chart, or the 3-day chart is stronger than the daily chart. The daily chart will now be stronger than the 4 hour. So if you see a candle form on a daily time frame, or a price action form on a daily time frame, you'll be like, wow, this is a very, very, very strong sign that this thing is going to make some moves. Or if you see a price action form on the 4 hour time frame as compared to the 1 hour, the 4 hour is stronger than the 1 hour. So the higher time frame you trade, the more confirmed move you get, and the more solid the trade is probably going to be, and the less faked out. The lower time frame you trade, the more the price action can be a little bit wishy-washy, and it can fake you out a lot. So for example, let's go to the 15 minutes. You can see from the 15 minutes, so this is how it works. Every candlestick represents 15 minutes. Every time a candlestick is formed, whether red or green, it represents 15 minutes, and each of these 15 minutes will probably represent 1 hour. So it means that the 1 hour time, the 1 hour chart will be a little bit more compressed. So you can tell from here. So it means this 1 hour has a lot of 15 minutes, 1 2 3 4 15 15 15 15 15 minutes inside there. We also have the 5 minutes time frame, means that there's a lot of candlesticks that form. So but like I mentioned, the higher the time frame, the more confirmed the move. So for example, you can still that this 15 minutes has a lot of candles, green, red, green, red, green, red, green, red. But when you come to the 4 hour, it becomes just the red, and you can clearly see that, okay, this thing, price got rejected here. The likelihood that the sellers are in action is very, very high. Price got rejected here. This is a 4 hour candle. It was selling off the whole time. Or for example, this candle, this is a 4 hour candle. This is a very strong bullish trend. It means that yes, like the buyers came in here, and for the past 4 hours they've been buying a lot, and 4 hours is a very, very long time for people to be buying this coin to the upside. So each of these candlesticks, they speak a lot. So the kind of, like I mentioned, the kind of trader you are would determine the kind of the time frame you trade. So a lot of people who swing trade will typically be looking at the daily time frame, the weekly time frame, and even the monthly time frame, because they want to probably hold the trade for like weeks and weeks and weeks. The people who trade maybe even the 4 hour time frame, the people who trade the daily, the day trades, or they trade and take their profit for the day, or even like maybe a day or two, they probably will be looking at the 1 hour time frame, because they want to get into the trade. The trade does what they want, and then they quickly get out of the trade. And then scalpers and people who are like looking to be savages in the market and just take their profit really quickly, probably be trading like the 1 minute time frame. Like 1 minute time frame, every candlestick is a 1 minute, so you can see like a lot of movement. So if you were going to sell, you sell here, and then you take your profits as quickly as possible. So within the next 1 minute, and then a few seconds, a few minutes, you should be out of the trade. So there are various types of trades. So if you are typically a swing trader, you would hold your trade for longer. You want to be looking at the higher time frames, because you don't want to be looking at the 1 minute time frame when there's a lot of noise. You want to be looking at, say, the 4 hour time frame, where you can actually see correct moves that's happening in the market. If you're probably a day trader, you want to be looking at between the 1 hour, the 4 hour, and the 15 minutes, because those are the candlesticks where you can actually take your profit within a day or two. If you're actually a scalper, you want to be looking at the 1 minute time frame, and then quickly get in and out of your position quickly. So the type of trader you are, your lifestyle will determine the kind of time frame you trade. If you're an investor, you're probably looking to invest for like 4 years. You're not looking at the 1 minute candle, you're not looking at the 4 hour, you're probably looking at the weekly candle. So okay, Bitcoin closed here, like this was the buyers came into this picture, so you can clearly tell. So when the buyers came into this picture, they bought the price all the way back up, and that's a very strong indication. Again, the weekly candle here is very strong. The likelihood that the price continues to the upside is very, very strong. But again, we got to play the concept, support, resistance. You can actually tell when price got to 32,500, somewhere around here, it got rejected. So when it gets here, will it get rejected again, or will it continue to the upside and break trend? So all of these concepts come together to form a very strong technical analysis when it comes to trading. So when we're also talking about risk management, remember I mentioned that when you are trading, for example, let's go to our spot trade once again. our spot trade tab once again. Let's just see. So if our entire fund that we're trading is $15, we do not want to put all the $15 into one single trade. What if that trade goes wrong? What if that trade goes badly? That means our $15 is all gone. We do not want to do that. We want to probably put in just you want to put in at least 1 to 3% of your entire money. So 1% of $15 is how much you want to be putting in, or 2% of 15, or 3%. So say for example, let's take hypothetically, for example, if you have $15 to trade with and you're putting in $1 per trade, that means that you have to lose 15 trades for you to blow your entire account. Like, if you know what you're doing, typically you shouldn't lose 15 trades at a go. And also there's something we call risk to reward. We're going to be talking about it in detail. Risk to reward, that comes along with risk management and all of that stuff. So if typically I'm putting in $1 into my trade, and every trade I go for like 1:2 or 1:3. So for example, if I win one trade, I'm winning $2. So if I win one trade, I'm winning $3. So if I take, let's say, 10 trades and I lose 5 and I win 5, I'm typically, let's say I'm going for 1:2. So once I win 5, I made $10. I lose 5, I made $5. I've lost $5. So give and take, my net would now be $5, and I'm profitable at the end of the day. So all of these concepts have to come together. I'll be making detailed video on risk management, on on risk management, and how to manage your trades and how to manage your portfolio. So these are the concepts when it comes to trading as a very, 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 very new beginner. So we'll be covering a lot more of this video. If you need a one-on-one session, and if you need me to go over some of these concepts, I mean, I'm open, and then we can talk about it. So basically, these are the concepts when it comes to trading. And of course, this is not like an extensive area. We can't finish all of this stuff in like one day. This is a whole candlesticks alone is a whole thing. Resistance, support is a whole thing. Supply and demand is a whole thing. Chart patterns is a whole thing. Like, we need to look at all of these as a whole. So we'll be doing a lot more videos. But once again, if you want us to go over some of these things, you can always hit me up in the DMs, and then we'll take it up from there. So if you are not yet subscribed to the channel, please subscribe to our YouTube. Follow us on Twitter. Follow us on all platforms. We're going to be doing a lot more video content, and I'll be on standby for more questions. So till the next one, peace. I'm out for now.